Today, we have a very special video to share with you. We're going to take a look into the mind of one of the world's greatest investors, Warren Buffett. In this video, you will learn about this great investor and his 5 investing principles. So without further ado, let's get started. Warren Buffett is one of the most successful investors of all time. In 2021, his net worth tipped the scales at $102 billion. He started by buying his first stock at the age of 11 and went on to file taxes for the first time at the age of 13. Today, he runs Berkshire Hathaway, which owns more than 60 companies. He has 5 key principles that have led to his success. His number 1 principle of investing is to invest in what you know. Before investing in a stock, it is very important to understand what a company does and how it makes its money. This is important because you need to understand the company in order to give it a proper valuation. If a company's business is outside of your area of competence, it's best to avoid it. For instance, you have to do a comprehensive analysis of their product. What is their technology, their future roadmap, who are their main competitors, what is their revenue growth, how much cash on hand the company has, and so on. Let's say Buffett has a pretty good understanding of online retail business and he finds various companies of this sector. Then he chose Amazon to invest in because he thinks it will perform better than its competitors in the coming years and will give him higher annual returns. The second principle of investing is to invest with discipline. He stresses maintaining discipline when purchasing companies. He makes his rules and sticks to them. For example, stocks go up and down. There is no game where the odds are in your favor. But to win at this game, and most people can't, you need discipline to form your own opinion and the right temperament. You will have to stick to your stop losses, profit targets, and the position sizing. If you are entering a trade in the company MasterCard and your strategy for entering the trade is based on technical indicators such as RSI or anchored VWAP, then always stick to your rules. Do not let the emotion overpower your trading decisions.
Do you find this video interesting? Hit the like button, subscribe to our channel, and ding the notification bell to stay up to date on our latest upcoming videos.
The third key principle of investing is to invest for the long term. He believes that investors should feel like they're part owners in the companies they buy for their portfolios. In his 1996 investor letter, he wrote, "Your goal as an investor should simply be to purchase, at a rational price, a part interest in an easily understandable business whose earnings are virtually certain to be material higher 5, 10, and 20 years from now." For example, you should never focus on swing and day trading. Instead, look for longer-term perspective. A great company with great fundamentals. For example, Buffett has a huge investment in Apple. He doesn't get profits in days or weeks. He has held the position for years considering the management team, public demand, and technology of the company. The fourth principle is be aggressive during tough times. You can do this by buying great companies with strong fundamentals and keeping your eye on the long term. Markets will rise and fall for many reasons, but most of the declines will be relatively temporary. It's important not to be panicked and depressed along with the market. You do this by keeping your eye on the future and ignoring short-term market corrections. Ignore the headlines about the trade wars, the government shutdown, and other chaotic news. For example, S&P 500 index will go up and down, sectors will have corrections, oil prices will rise and fall, impacting the stock markets. There will be many analysts speaking all the time on CNBC, creating hype. All you need to do is to not care. Do not panic and hold your position. The last principle on our list is don't be afraid to sell losing stocks. Although he's said over and over that he invests for the long term, Buffett's not afraid to sell if fundamentals have changed and he's no longer optimistic about an industry. For instance, if the company revenue is declining, if they are not doing well and fundamentals change over time, then do not hesitate to take a loss and sell your position instead of widening your loss in the future. For example, if something big happens to Alibaba and their quarterly and yearly revenue growth slows down, the company is not able to cope with the issues and stock has started to decline, then you should not be afraid to close your losing positions and take the small hit instead of widening your losses. We hope you found these principles informative and are able to incorporate them into your own investments. Be sure to leave any questions or comments down below. And as always, be sure to check out our other videos on financial topics.